Hey everyone, welcome to the KE Report and another daily editorial. This time chatting with Dave Erfle. Dave is the founder and editor of the Junior Miner Junky. Now, Dave, it was last week that we did a later in the week editorial that really focused on the precious metal stocks diverging from the broad US averages, and we're even continuing to see that today on March 11th with the markets continuing to fall. The S&P, Dow, Nasdaq, those are all down. Well, the S&P is down 0.5%. It has rebounded a little bit here. It was down over 1%. The Dow is still down over 1%, but precious metal stocks, those are up again today. Yesterday was a bit of a different story, but a very encouraging rebound in the precious metal stocks. And gold, hey, that's still hanging above that $2,900 level, up a little bit today, with silver also rebounding from yesterday's sell off. Dave, one thing you were pointing out to us off mic is that you're seeing a whole lot of geopolitics continue to drive interest in precious metals. Look, we still have a couple physical wars ongoing around Europe. We also have, quite frankly, a trade war that the US is engaged in with a whole lot of different countries around the world. So, multiple wars, geopolitics. Take us through, Dave, just how much you think this geopolitical and, quite frankly, these multiple wars ongoing and just really ramping up, especially on the trade front, how much you think this could continue to support gold and how much higher it could drive the precious metals.
Yeah, I mean, if you take a look at the gold price, Corey, it's created another symmetrical triangle consolidation pattern. The last one we had was when gold reached 2,800, and that one lasted 3 months. This one is tighter, and it's just a few weeks now. And also got to factor in that gold is extreme overbought on a monthly basis and due to correct at any time. But with what's going on in the world on these on trade wars and physical wars, I mean, Ukraine yesterday, they launched their biggest ever drone attack on Moscow. Yesterday we had the gold price come back down and gold futures test 2,900 and silver futures test 3,250. And they're right back up again after this Ukraine attack. And at the same time, in Romania, their electoral commission on Sunday, they banned the candidacy of the far right candidate Kalen Georgescu in the upcoming presidential elections, and that has triggered serious unrest erupting in Romania after he came on X and said this is a direct blow to the heart of democracy worldwide. Europe is now a dictatorship. Romania is under tyranny, and that basically angered the people, and they're taken to the streets in Bucharest and have attempted to force their way into the electoral commissions building. So all this is going on. We've got physical wars, we've got tariff wars, we've got the stock market now. The Mag 7 now is down now 20%. If you judge it by the MAGS ETF, MAGS, that's down 20% now. And like you said, the S&P 500, it's bordering on getting down to 10%, which is a technical correction territory as well. The Dow is not as close yet, but we had the AI and Bitcoin have been basically leading this correction lower, and they're off more than both the S&P and the Dow. I mean, Bitcoin looks like it's double topped at 108. And like I said, the AI stocks, the magnificent stocks aren't so magnificent anymore. They're starting to really sell off hard. So gold is taking all this in stride. And what's really important to note here is the gold stocks are really taking it in stride, right? I mean, they've had a nice run since the end of December. They've been outperforming the stock market. Gold's been outperforming the stock market. Gold against the S&P 500, as a matter of fact, is in the process of breaking out of a 4-year base right now. But if you take a look at GDX and GDXJ, they're also forming symmetrical consolidation patterns. And we're coming up on a monthly, quarterly close here at the end of March with a very important Fed meeting coming up. So if we get a close above 43, which has been 4.5-year resistance in GDX, we get a monthly, quarterly close above there. and we get that monthly quarterly close above 3,000 in the gold price, that'll bring a lot of attention into this sector.
Well, Dave, when you think about what you just laid out there, this is the kind of scenario we've been waiting for literally for years. Like
Right.
where we've been waiting for the gold stocks and gold to outperform U.S. equities. We've been waiting for U.S. equities to show weakness. Geopolitical events and all those kind of things, and even the tariffs will probably eventually cool off a little bit. Those things are always fleeting. But the price action on the charts and the price action we're seeing on not just gold versus equities, but also what you've laid out in GDX, and I would also argue GDXJ has done well recently. Those are the kind of things we've been looking for a while. Is this the period where maybe more generalists also wake up, even if we don't have that amazing monthly close, just to the fact that the outperformance is now stark in the precious metals versus U.S. equities?
Yeah, I mean, I've been mentioning ad nauseum in my newsletter and in my weekly column that the key missing ingredient in this phase of the gold bull market has been Western retail investment demand, especially from the US. As investors, they've been distracted by AI and crypto that have just been keep going up. But now recently, the global ETFs, gold ETFs, have seen continued inflows during February as holdings across all regions have grown. And at the same time, Bitcoin and NASDAQ, dominated by the Mag 7, they've led the way to the downside during the stock market correction. So that is proof that we're starting to see some rotation into the gold market from Bitcoin and AI.
Dave, are you noticing any outperformance then in any certain sector, subsector of the precious metals stocks in any way? Or is this simply just kind of being led by the large companies' revaluation of these stocks?
Yeah, I mean, what's been in the lead is still the majors and the royalty companies, right? You take a look at Agnico, they're at all-time highs. Franco-Nevada just came out with a fantastic Q4, and they made a 52-week high on their financials. Royal Gold, Wheaton Precious Metals, and in the juniors, you got Alamos Gold, Harmony Gold, these other. So you're seeing outperformance in majors, some mid tiers, and the royalty companies. Eventually, that's going to trigger down into more of the juniors. You're also seeing it. I hold several juniors that are trading at 52-week highs or close to it, and some of them are even at all-time highs. But that hasn't transferred into that sector wide as of yet, and I really don't think it's going to happen where the rising tide is going to lift all boats, because there's still issues in raising capital in a lot of these smaller juniors. And let's face it, a lot of these smaller juniors, they're de-risking properties that are never going to become a mine, and the market is aware of that. So you still have to be a stock picker.
Yeah, Dave, I don't know that that's going to change anytime soon. To your point, I think you're still going to be a stock picker in this market where you look for the quality, the companies with access to capital, the right jurisdictions, the projects that matter, the projects that could actually be takeover candidates. So it's nice to see a little separation of quality and the rest of the sector. One of the things I noticed on my dashboard today is just the outperformance of the silver stocks. Silver is back above $33. Obviously, silver can be that speculative metal more so than gold. The mining stocks, both gold and silver, both tend to track silver. What do you make of the silver stocks having a nice surge here?
Yeah, the silver's doing the same thing, right? It's in a consolidation triangle as well, but the consolidation triangles in GDX, GDXJ, and silver, they're showing relative strength. So they look like they're about to break out of them sooner than the gold price is, which is very bullish, right? Because basically what you have historically is you've had, silver and the gold stocks have lagged the gold price when there's about to be a gold correction, and they lead the gold price when there's about to be a gold breakout. And that's what's been happening over the past 4 years, while the GDX, GDXJ, and basically silver have formed these cup and handle patterns. And that the price to watch at the end of this month and quarter on silver is $35. So if we get that monthly quarterly close in GDX above 43, and the gold price in gold futures in 3,000 and silver in 35, that would be even more bullish, because 35 has been pretty strong resistance here in the silver price going back about 12 13 years. Like 43 has been strong resistance in the GDX going back about the same time.
So, Dave, when you're looking at your portfolio and you see some of these stocks that aren't at 52-week highs, quite frankly, maybe they've been range bound for the last couple years. They seem to bounce around. They're not breaking down to, let's say, 52-week lows, which some of these smaller juniors are, but they're just not putting in those kind of gains that I'm sure people see in other stocks within their portfolio. There are a lot of stocks that are doing very well. What do you do, or how do you view those companies that, again, they aren't breaking down, but they aren't breaking out? They're kind of just trending sideways in a boring fashion.
Well, you have to view them on a case by case basis. There could be several reasons and different reasons for each one. It could be a company that's having a hard time raising capital, or it could be a lower margin deposit that they're de-risking, or the company might have too many shares out already, and the street knows they're about to raise money. They have to raise money, and maybe in their previous financings, when they had to raise money, they had to attach a half warrant or a full warrant. So you want to look at the companies that are cashed up for the next 12 to 18 months, preferably. They've got access to capital if they're not cashed up. They've got a tight share structure. They've been able to raise capital without having to attach a warrant, and their projects that they're de-risking have blue sky potential. They're in safe jurisdictions, and also, as with what they talked about over the past few mining conferences in BMO and PDAC, these governments are starting to realize that, hey, they need to start fast tracking the permitting process to get these minerals out of the ground. So that's another positive.
Well, Dave, just from an investor psychology standpoint, when we start seeing the stocks take off, the ones that are, and people hold those in their own portfolios, there's that tendency, because we've been beat up so much and we've been hit in the face so many times, there's that tendency to take profits. How will you avoid pulling profits too early if gold does break 3,000, and if silver gets back up to 35 to 40 in that range, these things are going to keep running. How do you avoid the temptation to pull profits too early?
Well, I have rules, right? I mean, I have a system. I've done this for so long that I've been able to put in a system that's worked for me over the past, several years. I mean, when I first started out in this sector over 20 years ago, I really didn't know what I was doing, which was a good thing because, all the mistakes that I made, I learned from all of them. And I've set up a pretty good risk management system. So, if I have rules like I'll never put any more than 5% into one company, and if that one company becomes 15% of my entire junior portfolio, I'm going to sell one third of it to get my original investment off the table and hold the rest for a takeover. When you're buying these juniors, the ultimate goal is a takeover. Of course, you don't want to see that takeover too soon, but that's what your goal is. And the only reason why you should sell it is if management starts doing something stupid, or that they've missed windows to raise money, their share structure gets too blown, they've got too many warrants out, something happens with the project, it doesn't look so robust anymore, what have you. Then you just switch that position out and put it into something else. But you have to have rules, and your own rules. I mean, everybody has their own rules that work for them, and I'm teaching these rules to my subscribers as well.
One theme that we talked about a fair bit last year, too, that ties into the access of capital, but more on the investor front, not so much on the raising of money front, was the importance of a U.S. listing for companies. We saw a lot of companies add U.S. listings, quite frankly, just do better last year. And we did attribute some of that to the fact that they had that U.S. listing. Is this still a focus, Dave? Do you see at least the potential of U.S. investors, even though it has been slow on the demand front and low volume in these ETFs, that still should be a fairly important factor when you're looking at these companies, that they should have a U.S. listing?
Yes, it is important because, once retail finally starts coming back into the sector, and I believe we're close, you want to have that listing, because then, a lot of these people that get into this sector, their stocks that they're exposed to are in retirement accounts, and retirement accounts cannot invest in pink sheet listed stocks. And also, if a lot of these funds, they can't get into pink sheet listed stocks either. And these juniors, it's better to have this U.S. listing to make it more attractive to U.S. funds as well. So yeah, it's really important. It's one of the first things I ask a company when I'm doing due diligence and I have one-on-one meetings with them and I'm considering taking a position in their company. If they're a late stage company, I'll ask them if there are any plans to get a U.S. listing once you secure funding, because it is expensive to get a big board listing. It's more expensive to list on the Amex and especially on the New York Stock Exchange. So that's something that is important to me if the company is considering doing that once they're fully funded to construction.
Yeah, Dave, I think this is such an important topic, and we've talked about it before, but I mean, you can tell just on a day like today, the stocks that have the dual listing are getting way more volume in the US than the ones that have OTC listings.
Right.
Now, there is the point that a junior could make, and we've heard this when we ask companies the same question, that, hey, we just really can't afford it, or we don't know if it's worth the candle. What would you say to some of the ones, though, that they probably are big enough, but they're still dragging their feet on it? But they assume, well, we got a TSXV listing, or we got even a TSX listing, and we've got the OTC QX or QB. Shouldn't that be good enough? It's really not good enough, and there's a lot of platforms that can't even buy OTC stocks. So what would you say to the juniors that just drag their feet on this topic and they refuse to do it?
Basically what you just said. It's really not good enough. I mean, if you want to attract US investor capital, and that's where the big money is, right? Then you should get that big board listing. You've got the funding now and you can afford it. Some companies have done it too soon and it took away too much money from their G&A or whatever they're trying to do. But because it's a fine line on the timing of doing it, right? I mean, you have to have investor interest in the first place in that subsector before you take the step to get that big board listing. So if you're at that juncture in your de-risking of the project where you expect to receive more US investor capital interest, then definitely you take that next step and you get that big board listing.
So overall, Dave, what about seasonality? Do we need to be paying any attention to seasonality right now when it just seems like this year is a fair bit different simply because of, again, geopolitics, wars, trade wars, and the markets going through one of their more significant corrections in well over a year?
Yeah, I mean, you've got the trifecta, right? You've got a stagflationary recession fears going on right now. You've in the middle of a sovereign debt crisis at the same time that central banks continue to buy gold. So, but at the same time, it's extreme overbought, on a monthly basis, and it can correct at any time. Part of me wants to see a healthy correction here before it gets over 3,000, but the markets don't move for me. I mean, I just have to track them and see what I see and invest accordingly. So I definitely wouldn't want to short anything gold related here. But as far as, buying physical gold, I mean, it's really overbought. I mean, if you want really good leverage to the gold price, you basically you want to get into the mining space where the leverage is and where the undervaluation is. I mean, that's where the leverage is, as well as being historically undervalued to the gold price at the same time when you have an overvalued stock market rolling over and showing strong signs that we're finally going to have at least a 20% correction that we haven't had in a couple of years, and sector rotation finally coming into gold stocks.
Dave, in light of the fact that the U.S. equities are showing weakness and the gold stocks and silver stocks are still equities, many people believe they're just going to get sucked down the drain with everything else. But then again, if metals prices keep blasting higher because they're attracting the bid and they're diverging, that would seem to buoy them. But then you also just made a great point. They're still undervalued, the mining equities, compared to the metals themselves and the move we've already seen. Even if metals just went sideways here, but the markets kept correcting, could the gold and silver stocks keep revaluing higher even in light of all the headwinds to U.S. equities?
Yes, I mean, that's what we've been waiting for, right? We've been waiting for that mean reversion to start happening. And mean reversion could easily happen, like you said, with the gold price still trading sideways below 3,000 or right around 3,000 while the stock market continues to roll over. And then you have investors looking for safe havens. And after taking their massive profits from AI and crypto that they're being forced to take now because, the topping patterns that are obvious here, everybody sees them and they're getting more and more nervous.
Really just seems to all be lining up for precious metals right now. Price action has been definitely in its favor for over a year now, we can consistently say. And quite frankly, it's been almost a 10-year uptrend for gold. Silver, yes, that's been choppy, and the gold stocks. They've really just started taking part in this over the last year, at least a wider range of these stocks. I know it's not that whole revaluation of the sector, but I continue to argue that that's a good thing, because when we do see that revaluation and those juniors flying, that usually signifies end of the market behavior. And hey, we're still not there yet. So if you're in the right stocks, you're continuing to do very well in this sector, and now even more so when you consider just how much the broad averages are struggling. And really, globally, there are a lot of worries out there, which only lead more people into the precious metals, and we are definitely seeing that. Dave, thank you as always for your time. Everyone, be sure to click that link in the show notes to visit the Junior Miner Junky website. Considering signing up for Dave's newsletter if you are an investor and an active investor in the precious metal stocks. Dave, have a great rest of your week.
You two guys, thanks.